Namaskar, welcome to our another video designed specifically for legal professionals, law students, and anyone keen to deepen their understanding of legal frameworks. Today we are going to do a quick revision in a simple language. You may download complete notes from the description link or from the first comment of this video. Let's start. The topics which all are covered in the entire notes are as follows.
Namaste friends, welcome to our banking and insurance law class. Today we are starting with the evolution of banking services and its history in India. Don't worry, I'll keep it simple with real world examples so that you will understand everything. Evolution of banking services and its history in India. Let's begin with a trip back in time. Imagine India before 1786. There were no big banks like SBI or HDFC. Instead, we had Seths and Mahajans, local moneylenders who gave loans using something called the Hundi system, which was like an old-fashioned check. Then the British era brought modern banking. The first modern bank, the Bank of Hindustan, was set up in 1770. It didn't last long, but it opened the door for others. Soon we saw the three big presidency banks: Bank of Calcutta in 1806, Bank of Bombay in 1840, and Bank of Madras in 1843. These were mainly for British trade and administration. In 1921, these three merged to form the Imperial Bank of India. And in 1955, after independence, that became our State Bank of India. If you think of banking history as a family tree, the presidency banks were like grandparents, the Imperial Bank was the parent, and SBI is the child we know today. In the 1960s, the government felt banks were lending mostly to big industries, ignoring farmers and small businesses. So in 1967, they introduced social control, basically telling banks to lend more to priority sectors. But it didn't work as planned. Then came the big move, nationalization of banks. In 1969, under Prime Minister Indira Gandhi, 14 major private banks were taken over by the government. The idea was simple: shift focus from profit to public welfare. Think of it like taking over a private bus service and making it a public bus, so everyone, even in villages, gets transport. In 1980, 6 more banks were nationalized. The results: banking reached rural areas, farmers got loans, but political interference and bad loans also increased. Now, let's talk about the different types of banks and what they do. RBI, the central bank, like the principal of all banks. It controls money supply, issues currency, and regulates other banks. Commercial banks, everyday banks like SBI, PNB, ICICI, HDFC. Cooperative banks, community-based, often serving farmers or small shopkeepers. Development banks like NABARD and SIDBI, focusing on agriculture and small industries. Specialized banks, small finance banks, payments banks, regional rural banks, jointly owned by the central government, state government, and a sponsor bank. If banking were a cricket team, RBI would be the captain, commercial banks, the main players, and specialized banks, the fielding specialists. When you open a bank account, a legal relationship begins. If you deposit money, the bank is the debtor, you are the creditor. If you take a loan, you become the debtor, bank is the creditor. Sometimes the bank acts as your agent. For lockers, the bank is like a bailee keeping your property safe. Rights of the banker: they can set off one account against another, charge interest, and close accounts with notice. Duties of the banker: honor checks, keep your information confidential, maintain records. Rights of the customer: to draw checks, receive statements, sue for wrongful dishonor. Duties of the customer: keep checkbooks safe, fill checks carefully, report irregularities quickly. Banks do much more than hold your money. Transfer funds between people and businesses. Help form capital for economic growth. Run the payment system and EFT, RTGS, UPI. Create credit, facilitate foreign exchange, and promote financial inclusion. Banks are like the heart in the economy's body. They pump money to where it's needed. Lending by banks and recent trends. Think of advances as short-term help and loans as long-term commitments. Advances like overdraft, withdraw even when empty. Cash credit for businesses, borrow against stock. discounting of bills. Sell your bill to bank at discount. Loans, fixed purposes like buying house or machinery. Cash credit is like having a water tank that you can fill and use anytime and you only pay for the water you actually draw. Securities are like safety nets. Direct, pledge, gold loan, hypothecation, car loan, mortgage, property, assignment, life policy, lien, collateral, guarantees, fixed deposits, miscellaneous, book debts, bonds. Default means failure to pay. After 90 days overdue, it's an NPA. Before 1993, recoveries were slow. Then came DRTs for faster action above 10 lakh rupees. Sir 5 Years Act. 2002 allowed banks to take over and sell secured assets without going to court. That's our entire course from ancient Hundis to cyber insurance. Keep learning and stay curious.